the Whitkin Guide to Stock Investing, where I'm going to try to explain it to Oscar. So this guide is intended for people with some money to invest. They don't really have time to like micromanage, or they're not wanting to be professional investors, and they don't really have ever invested in stocks before. Is that you?
I don't have 10K to invest, but otherwise, yes.
Great. So let's say our goal is to live on passive income, which is a common recommended strategy of long-term growth investing.
Yep. Mm-hmm.
And to do that, I'm proposing basically there's three phases. The first step is you buy some stocks, particularly growth stocks. Then you wait and ignore for a number of years. And then you start harvesting your annual income forever. Here's an example. Let's say that you did have 100K and you bought it back in 2011. It would take this many years for it to grow in value until it reached a number, let's say $3 million. Once it reached some number you cared about, you felt like sure that was a ton, then you would start taking out, let's say 280,000 a year as your to live on. This is what would have actually happened if you had done that. It would have taken that many years. You would have grown that much, but you took out the red amount. Next year, this blue amount grew that much up to the top of the red. You took that out down to the top of the blue. The next year, the market crashed and your blue shrank all the way down, which looks horrible until you realize you still have over $2 million. So you're like, oh, that's fine. So you take out the red amount again, even though your market crashed. Next year, it grows up again, and you just keep doing that forever.
Makes sense.
So that amount that the market's going to grow every year is a really important number, and we estimate 30% annual growth every year of whatever stocks you put in.
How do you estimate that?
Good question. So I'll answer that in the next slide, but on this slide, it's trying to see that 30% is fairly conservative over this particular period of time, which I'm calling fairly average, fairly typical over every period of historic time. Some years it grew a hell of a lot more than 30%, more like 70. Some years, like 2015, it actually didn't quite grow 30%. But the average, 30% is a conservative average. That's what I'm trying to show.
Right.
It's also a lot higher than most other stock indexes or funds you can invest in. Like here's one from Vanguard that you could buy that typically grows about 16%.
Why are all of them so low?
Good question. I will answer that in the following slide. There are a few that do perform this well, and they basically buy stocks called FANG, which is Facebook, Apple, Netflix, Google. Amazon. Okay, so before I answer your other questions, I've actually maybe I'll skip ahead to slides that talk about.
It's fine. You can answer them in time.
Okay. So then that case, next slide is around how bad could it be. And the very worst time you could have bought in any time since 1992 was the year 2000. And this is what would have happened. Your stocks would have grown at 30% the first year, and then not so much, almost 30%. And then they would have fallen again. And then they would have puttered along at some much lower rate, which is about 16%. They would have eventually caught up to the 30% off the chart here.
Yeah.
But it would have taken a lot longer, specifically 16 years for your 100K to go to 3 instead of 9.
Yeah.
Sorry, 11. Yeah. Any questions about that?
No.
This is the very worst period.
The worst case is an actual thing that happened, or is it
this? Yes, this is all that happened. This is the real value. This what?
Your portfolio generally.
I took my portfolio. I looked at how much it would have been worth in 2000 and how much it would have grown every year. Okay. Those stocks.
Right.
I didn't have actual money in it, but I just looked at if I did, what would my money have done? So here is what actually happened. In 2021, we put the money from selling our Hilton house into the stock market. And then this right now is if we sold it today, we would be up 43% cash on cash.
It's not bad.
Yeah, in 2.5 years. And we had a different fund, E-Trade, which we bought over time. We didn't buy all at once. So its numbers are quite different because this was really bad timing. We bought right before a big crash.
Right.
So the spread out one, we're just recording, is took longer. Sorry. So I'll say that again. So the second fund, E-Trade, we didn't buy all in a lump sum. We did what's called dollar cost averaging, which means you just buy a certain amount per month every month.
Mm-hmm.
And so you can see its results are much better because we
Yeah.
didn't put it all in right before it crashed.
Mm-hmm.
And we also held it a little longer, 3 years. So both of them are doing numbers on
Yeah.
par with what I was saying.
Nice.
Here's the actual movement, like week to week,
Mm-hmm.
of our stock portfolio value. So you can see it's kind of the dotted line represents the overall trend, but it's not that obvious in this shorter timeline.
Yeah.
Right? It's kind of hard to see.
Yeah.
And NASDAQ composite means just basically all the major tech stocks averaged
Mm-hmm.
together. You can see that our portfolio is doing a lot better than that one.
Yeah.
And that one does about 16% typically.
Right.
And that's 16% is pretty typical over any time period you choose for NASDAQ.
Mm-hmm.
So what's in our portfolio? Well, currently a lot of NVIDIA because it's done really well the last couple of years. When we bought our portfolio, this was about half that size. The other ones are major tech stocks, basically, or chip, basically suppliers.
Yep.
It's a couple of Chinese companies, Baidu, and we have some Tencent. One real estate company that I probably shouldn't own and haven't bothered to sell yet, but mostly just big tech stocks.
Mm.
So this insane chart, you can just look at the colors.
Yeah.
You don't have to read the numbers.
Okay.
Basically, you're looking for bright greens.
Yep.
Like here in 2020, this stock, which is Enphase, had the 400% growth.
Damn.
And then the next year had another 500% growth. So you'll notice that the green boxes don't all line on the same stock.
Mm-hmm.
That stock didn't do much. I mean, it's done all right. It dropped, it grew, but then it had a couple of amazing years. Each stock generally has some period of amazing years, and they're not all lined up in a certain decade.
Mm-hmm.
They're spread out. That's why you have to wait so long to hit those big booms.
Right.
But you can also notice that some columns are all red.
Yeah.
So crashes happen to all stocks.
Mm-hmm.
Booms happen to certain stocks.
Okay.
The other thing to notice is these are all indices. These are not stocks. These are groups of stocks, portfolios that other people have made. That Vanguard fund I mentioned is a collection of tech stocks.
Mm-hmm.
And none of them have had big green years.
No.
They
They
all
have
kind
big
of,
red ears then.
yes, they have big red years and they have kind of anemic. This is 63% growth. That's good. But it is nowhere near 400% growth.
Yep.
Right. So the basic, if you bought and sold our portfolio in any random 12-month period, you could lose half your money.
Right.
You could also gain more than double your money.
Yep.
On average, you'd get a 42% growth. If you held it for 24 months instead of 12, the worst case since 1992 is you would lose 11%. That's way lower risk, right?
Yep.
5 years, the worst you do is gain 16%.
Mm-hmm.
So that's why everybody's talking about 5 years being a good holding period.
Yeah.
Because the absolute worst on record
Because you can still gain.
is still gaining, just not as much. And
Mhm.
10 year, it's even better. 24% minimum worst case gain over any period.
Nice.
So if you can wait 10 years, it's just so good.
Mm.
So this chart just kind of shows that the same red and green chart I showed before, but a little more direct head to head with a single index fund.
Mm.
So you can see that on bad years, ours was a little worse on bad years.
Yeah.
But on good years, it was way, way better, like 10x in some years. And that average just means that we're way ahead.
Mm.
Questions?
No,
Makes sense?
that sounds good to me.
Why don't those other stocks, why aren't they doing what we're doing? There's slides about that.
Mm-hmm.
And basically, they're trying to do something called diversifying. So they buy stocks in all different areas. They don't just buy all big tech stocks. And they're trying to achieve safety of reducing the drop in bad years, which they do. It is a little better than ours, but not that much better in bad years. And they miss all the big gains in good years.
Mm-hmm.
So we think that's a bad idea. To lower risk, we don't try to diversify. We just wait longer.
Mm. Interesting. All right.
The hardest part of this strategy is that you have to think long term about investments, and a lot of people who buy stocks don't want to or don't.
Mm-hmm.
They are all thinking like months or quarters instead of many, many years.
Yeah.
And this, so I do actually sleep well at night, even when the market's crashing.
Mm-hmm.
And that is the key. If this stresses you out, you shouldn't do it.
Okay.
The way I do it is I just think in where did I start? 100,000. Where did I end 5 years later with 400K?
Mm-hmm.
What does it do in the meantime? I really try not to care about that.
Okay. Yeah.
So if I can, that's my focusing, just the start and the end point, and I just draw a line.
Mhm.
Of course, that's very hard. Some years I'm like, oh my God, we're so rich. And then the next year I'm like, shit, we're losing money like mad. And that does make me worry that we should sell, right?
Yeah.
And I just really try not to suppress that. Like later in the slides, I have hints about how I suppress that thinking.
Yeah.
But this is another kind of slide along the same points of this is about any 10-year period. So if your 10-year period started a really bad one, let's say here in 2012, then your 5-year is down here at something like 15 or 20%.
Mm-hmm.
Your 10-year period, the 10 years prior, 2002 to 2012, was still above 25%.
Right.
So just reinforcing the point that whatever 10-year period you want will work if you're willing to wait 10 years. But if you get impatient and start looking at 2 years, there are some 2-year periods where you lose some money.
Yeah.
Most 2-year periods you do great, but there are some you won't. So yeah, set and forget.
Nice.
So what if you don't want to wait 10 years? Well, one thing you can do is put in more money and you'll have less time to wait. So if your goal is taking out $280K a year, which is a pretty damn good annual income, and you have more cash now, you don't have to wait as long because your portfolio will grow to that threshold of say 3 million, where you're quite confident that you can keep taking 280K and it won't matter even if the market crashes. So put in more money now and you don't have to wait as long. Another strategy to not waiting as long is taking out less money when your market when you're during crash years. So here we only put in 100K. It only grew. It didn't grow to 3 million before we started taking money out. It didn't even grow to 1 million. It grew to around 900K. We're like, yay, that's enough. So we took out 280K, which is a big chunk of it.
Yeah.
And it still grew the next year. It's like, yay, take out another 280K. But the next year it crashed and it shrank all the way down to like 500. And we're like, oh shit. So we didn't take out 280K. We did take out 100K. We thought, it'll probably grow at 100K. So we took it out and it did grow. 100K. And then it grew again. Or now this time we're a little gun shy. It's like, okay, millions maybe a little aggressive. Let's just take out 100K this year too. Then it went up to 1.5. We're like, okay, no, we're good. Take out 280K. And then it crashed again. Like, okay, all right, back to 100K. So you just keep taking out less when your portfolio is smaller.
Okay.
And if it ever got down to here, like 300K, we wouldn't take any out. Because we don't want to, eat the golden egg or kill the golden goose or whatever that is. Yeah, so that's a varying harvest, right? So that the only advantage of this is you don't have to wait as long before you start taking money out, i.e. the impatient investor.
Right.
It's definitely worse in every other way, except that you can start taking money out sooner.
Yeah.
So if you have cancer or something, you're like, dude, I don't want to wait 10 years. I'll probably be dead. Then, take the money out and just don't take it out if it ever shrinks.
That makes sense.
Because a lot of years you'll get lucky and it'll boom way up and you never have to worry about it. So in summary, you have really two important decisions. When to start taking money out. I mean, you have to decide how much money you can manage to put in. So how long can you wait? If you can wait 10 years, just put in a little bit now and wait. That's the safest thing to do.
All right. Seems solid.
So how safe is this compared to, say, buying a house or something? I think a lot of people feel like the stock market is unsafe and risky and gambling-y. And I don't. I think of it as it's a bet on the tech world generating commercial value and big companies capturing that value. And that's a pretty damn safe bet in the big picture. So this is a logarithmic scale. Every one of these lines doubles the value of the last one, 100, 200, 400. So this basically represents exponential growth of stock value since 1970.
Yeah.
That's a very stable pattern if you start looking at decades instead of years. Yes, there have been huge peaks, but if you just draw a line from here to here so that you're ignoring the peaks and you say, okay, let's be more conservative. Ignoring the peaks, what's sort of a good prediction? 30% growth is a good prediction, is my case to you.
Yep. Yeah, that seems to make sense.
All right. If you did want to do this, it's unbelievably simple compared to, say, buying a house or something. It's like as hard as opening a bank account. You do have to have some money.
Yep.
You decide how much of that you're going to invest, and you decide how long you're going to wait, like I said, and then you just go buy the stocks and open an account in something like E-Trade. You transfer the money with a bank transfer, and you buy the stocks that are on that slide I had earlier, and then you wait. And then
Alright.
you look once a year. You check, am I over 2 million or
Mhm.
whatever threshold?
Yeah, then you take it out.
And you start taking it.
Mm.
It's like literally 8 hours of your time to
Wow.
do this. It's so insanely quick, and it can change your life.
Mm.
So that's all the important stuff. Did I answer the questions you raised earlier?
I think so. Yeah.
Okay. Cool.
Sweet. Thank you. Is that it?
That's it.
Oh, cool. All right.